gold now has surpassed U.S. Treasuries. China then had around 33 million ounces of gold in reserves. It's now over 75 million. We remember when silver was $4 an ounce thinking it was going to do the run to $6. The fact it's at 60 and believe that'll continue to serve me well.
Now, you answered it there, but I mean, I got to go to the macro picture right now because just today, gold's selling off a little bit, but oil is spiked on Iran news, and the markets are now pricing in a Fed rate hike. Some banks have trimmed their targets, though plenty have stayed bullish, and central banks continue to pick up gold. From where you sit with all of your experience, is this a real turn in the cycle, or is it just kind of a breather inside the bull market, like you said?
No, I think it's a breather in the bull market. And one of the things that I think is different this time than, let's say, in the 2011 run-up when we had gold moving, that was largely driven by speculation, the retail investors within it, perhaps going in the ETFs. What we've seen is that systemic change now when you look at global reserves, monetary reserves. Gold now has surpassed U.S. Treasuries. Now, it hasn't surpassed, U.S. dollars if you look at all types of dollar investments. But, gold represents, 23 to 25% based on the World Gold Council of central banks' holdings. So, that's different. We're finding central banks continuing to buy. Again, when we started the Brucejack project back in 2010, China then had around 33 million ounces of gold in reserves. It's now over 75 million. And it continues to buy, as do other central banks. And so I think that's the shift with central bank buying coming in. And also some investment fund managers are coming back, realizing for looking at, the world politics and way things are going on, if they want kind of insurance or just be able to park some of their assets securely, we're going to see it in gold. So yes, we see these daily volatilities due to the news cycle, but long term, I think we continue to see that evolution of gold trending higher.
Yeah, it's a good way of looking at it. I mean, we'll have a technical analyst on, and I always remind people this is short-term trading, but we're looking at the longer picture. And I guess that brings me full circle to Hemlo, and it's a story that I promised I had to tell. I mean, you discovered the camp as a young geologist. Now, decades later, you're helping steer that company that just basically bought, I think, that mine from Barrick, yeah? And what is it like to come full circle 40 years later?
Well, it's great. I was there at the start, as you point out. I mean, it was David Bell who kind of did the discovery of the mine itself, and of course, the David Bell mine's named after him. But it was my first experience working at a exploration to develop a project, which helped me through my career because then I knew what a mine looked like, right? Here's how you explore, this is what it did. But to be able to go back with a young team, because when I worked there in the 80s, Dr. Keeble, the previous chairman of Teck, he and his father started Teck. When I was there, they were in their 40s, right, running, Teck as a mining company. And now I happen to be aligned up with a young professional group, between the CEO and COO and Jerry, John Odd, Jason Kozak, and John Case. And this young group who were enthused about being able to develop a Canadian mine where the resources and assets from the mine will stay in Canada, right? When Barrick owned it, of course, it was very small in their portfolio, and a lot of the cash flow generated went from it. So the opportunity came to us because it's been undercapitalized. It hasn't been explored. And what I bring is the fact that when I worked there, gold prices were, a few $100 an ounce or less, and we were mining 8 and 10 gram material. Right. We can now mine, 2 gram to 3 gram material. So it opens lots of exploration opportunities that I can remember. Yes, we drilled that hole, but we didn't go mine it because it was too low grade. Now it's ore.
This is interesting because, you talked a little bit about it, and you keep saying the younger generation. You're an exceptional mentor. I've been lucky to talk to you, and you've mentored me through the years.
40 years later, walking back into the same mine he helped discover as a young geologist? That's not just a career. That's a full-circle validation of a thesis he held on to for decades. If stories like this are giving you a real look into how the mining industry actually works behind the headlines, hit subscribe and turn on notifications. We bring you conversations with industry legends like this every single week.
Hemlo just lifted its resource by about a third, and you personally flagged that new zone. What are you and the team seeing that the major kind of didn't? Get a little into that.
Well, I would think it was the fact that Hemlo was a small component of Barrick, right? Over the last 5 years, Hemlo averaged maybe somewhere around 150,000 ounces a year to a mining company that's producing 4 million to 5 million, right? So it doesn't get the attention that you're going to be getting in the, let's say, the Carlin trend and some of the other assets. So as a result of that, that creates the opportunity. It's undercapitalized. They're not getting the money to be able to go in and drill. And to your point, what they've named in the press release, which is basically the west zone that we drilled, it was lower grade when I was working there in 82 and 83. But it currently, the data's still there. It was never mined. And so we're going back and drilling it off. And I think it'll become part of our mine plan. But more importantly, I was up at site a few weeks ago and being down at 1,500 meters underground, seeing what it looks like from the drill core and seeing these zones which are wider, more consistent because changing the cutoff grade just allows them to fill out. And that's what's exciting, is we can see lengths of these and it's still open at depth. So that's the great aspect, that we're going to be here many, many more years mining at Hemlo. And it's just really great to be part. The geology hasn't changed in 40 years.
Right.
The opportunity is still there.
You know, there is a little bit of a pattern here as well. I mean, the big finds so often come from small, hungry teams like you're talking about, not the giants. So, I mean, you know, why do the majors kind of keep missing what somebody like you sees?
Well, I think one of it is we go back to the industry. You know, if you go back, 25 years or more ago, when mining companies are really stressed with metal prices, they cut back on exploration teams, right? And so that's when you would see the Vancouver junior groups come up, where often it was ex-mining individuals getting together. So we can be much more efficient with the capital, right? If you're a large company, you've got a bureaucracy that you have to look through, decisions have to be made, whereas if you're a small group, like we were at Silver Standard with, Joe Ovsnick and Ken McNaught and myself, when we look at assets and the team we had around, we could make decisions really quickly. We're not getting the results we're getting here that we think we need in order to develop a project into a mine. So we would pivot and turn to another opportunity. So I think that's what you see, is that the large majors still have their exploration groups, but they're more about assessing what are the juniors doing and using that model, which is what tech was doing back in the 80s. Funding the juniors, having the juniors feed up into tech and being able to, turn it into the powerhouse it is today. And that's a model, arguably we saw a few months ago with the Nico Eagle, with Rupert, consolidating in Finland, letting the junior come in, do the work and presenting the opportunity. So it's a way for the majors to adjust their exploration risk and being able to let teams who want to get out and do that work and access the capital markets to be able to do it. So it's certainly a pattern that's working well, which ultimately leads, as you know, into M&A activity.
Absolutely. And I mean, we could talk about your career for a long time, but let's talk about it for a minute, because there is a lesson here. I mean, with Pretium, you took obviously Brucejack from a geological concept to, one of the largest mines in Canada. What did actually building that mine teach you that you kind of didn't know before?
It taught you to put the right team together, right? And I've had the great fortune when we started with Silver Standard to work with, individuals there that were able to come over to Pretium. But we had some experience building mines when we built the Perquitas mine in Silver Standard. And throughout my career, having worked at Hemlo, worked at Tarkwa, worked at Menantial, you were involved in that. But to actually take a concept.
Notice what he's really describing here. Going from a 4-person office team to 2,000 people building a power line through some of the snowiest terrain in British Columbia. That's the unglamorous, execution-heavy side of mining that never makes it into a stock pitch, but it's exactly what separates a real mine from a good story.
And start with it and go all the way through. You need to put the right team together and bring in those with the expertise, because originally our plan had been, let's go off and drill it, and eventually perhaps a major may want to come in and take it over. Because of the complexity of the deposit, we weren't able to do it, so we had to build it. And you go from a team of 4 or 5 people in an office to where you suddenly have 2,000 people working construction in one of the highest snowfall areas in British Columbia, putting in a 100-kilometer power line. That means lots of expertise and being able to bring people in and do it safely. And so it's all about team building and getting those right individuals to be able to get the outcome you want.
Yeah, well said, man. I mean, then you sold Brucejack to Newcrest for around $3.5 billion. That's the discipline that most people never master. So I have to ask you, I mean, how do you know when it's time to build, and how do you know when it's time to sell?
Well, in the case of selling, often a larger mining company may come to you and say, listen, we like your asset, here's a letter, here's a proposal. And, I learned that, from the namesake of the conference here, Rick Rule, many years ago, you're here to do what's in the best interest of shareholders. And so if someone is able to come in and say, listen, we're willing to give your shareholders a premium to be able to put this asset in our portfolio, then it's something we have to look at. In our case, it just took a while for that to occur and we had to develop the mine. But many companies here they'll go through and develop an opportunity. And once you've de-risked it, in the case of Brucejack, we produced, 300,000 ounces or so a year, and I think it's produced over 2.5 million ounces today. So we showed it was a real mine, and that then allowed the major to be able to come in and make that opportunity. So again, it's that cycle of the juniors being able to find it, and then having that opportunity that majors will come in and want to take over. And I think it's good for the industry.
Do you think M&A is just beginning now? I mean, it feels like management teams have been more disciplined with their capital.
Yes.
They're kind of looking at things from a different perspective this cycle. Is it just beginning?
Yes, I believe so. Well, we've seen, Equinox and Orla do their moves. So it's about being product up as you get these companies which have 2 or 3 mines now becoming 8 and 10 mines. Then we're going to continue to see portfolios move up. There's a lot of companies out there right now who have very attractive paper because they're operating, and the juniors continue to not get that attention. And so as good projects come along, you may find where majors will take, or mid-tier companies will take toeholds in companies and then be able to continue to fund them and ultimately be able to get those assets. But I think we're in a space with this gold price because, 20, 30 years ago, the mining companies, when capital wasn't available, got very disciplined. And, that's probably a little different in this cycle. Margins are good. Mining companies are making money. They're returning money back to shareholders, either way of dividends or through share buybacks, right? And we haven't seen that in this industry, as you well know, you've been in a long time, to what we're seeing, let's say, in the last 4 or 5 years. So that type of discipline is bringing other investors, institutional investors, because they can enjoy in the cash flow. But with the fact that most mining companies are operating with all-in sustaining costs between that 1,000 and 2,000 range, at these current gold prices and even what may be projected, there's still good margin in the industry.
Yeah, it's been fascinating to watch some of this cash. Well, I got to ask you about silver because you made your name in silver first. I mean, you built silver standards, so silver is in your blood. I know that. I mean,
Here's a connection most silver investors haven't fully priced in yet. Every new data center being built for AI needs hundreds of kilograms of silver just for its wiring, because nothing conducts electricity better. That's a demand driver that has nothing to do with inflation fears or central bank buying, and it's only getting started.
silver's run even harder than gold lately, then it corrected. And I got to ask you, as someone who knows that metal cold, I mean, is this the real move silver bulls are kind of waiting for? Is this a kind of time? I mean, silver's exciting right now?
Well, true. I mean, I can remember being with, my good friend Ross Beatty, as you interviewed us a few months ago. We remember when silver was $4 an ounce, thinking it was going to do the run to $6. The fact it's at 60, is I think a part of that trajectory along the way. As you point out, silver's a smaller trade, right? If you look at the gold overall production, it's around $500 million, silver 800 million ounces of production is around 30 billion, let's call it gold would be 500 billion. So it's a much smaller trade in that regard, and because it's always in deficit, then it's volatile. Mm-hmm. And you'll find that those that want to play that volatility will certainly invest in it. But I think, again, long-term silver is really looks good when we get around to AI. Yeah. We have our cell phones, right? Cell phones have a certain amount of silver and gold in it. If you look at data centers, and people talk about megawatts of power, I think of it as a construction project. Right, an acre of data centers is lots of concrete, it's lots of steel, but it's 300 to 400 tons of copper, right, and powering that goes inside. And silver, being the best electrical conductor, is all through the server platform, right, whether it's in the servers themselves connecting. So you can have hundreds of kilograms of silver, in data farms and data centers. So going forward, we're going to continue to have that industrial use for silver, but it just doesn't have central bank buying or anything into it because, again, it's a relatively small trade compared to others. So we'll see the volatility. But again, when I look and say, it's come from, in the last, couple of decades, it's come from $5 or $6 to 60. The silver investors long-term have been rewarded.
Actually, you bring up a good point. I remember that interview. We had you on the Legends panel with Ross Beatty, and he kind of got a lot of comments from some of our viewers because he said, listen, silver's a little frothy here at almost $100. We needed it to come down, and people thought, why? But here we go. We've established that $50 base, it seems like. Yes. And for the regular investor watching from here, gold, silver, which one has a better story and kind of why?
Well, the ring I have on here is electrum, so it's both silver and gold in that regard. I have proportionate investments in both. When I look at kind of the silver and gold 15-to-1, I have physical silver, I have physical gold, I have the equities in that regard. So I think it depends on an investor's tolerance for volatility. I think if you're buying gold equities, the long-term producers, but again, there's so very few primary silver producers that you can invest in, right? Because only 30% of silver production is from primary mines. Most of it's by way of byproduct. And so I think it's just good to have a balanced portfolio is how we look at. Again, I'm not an investment advisor. I'm talking about my own personal investment here in the United States. So I think it's one thing that each has to look at. But I think long-term precious metals as an investment thesis is something that people should
You like both.
consider. Yes.
And I mean, we could talk a little bit about the supply issue. I mean, the biggest picture of all is the metal itself here. I mean, exploration budget has been starved for about 15 years, as you know. As a discoverer, what does that actually mean for the world's future gold supply and I guess for the price?
So they're harder to find, they're deeper, they're lower grade. If you go to the turn of the last century, at surface mines are running 10 grams. The average gold mine nowadays is around maybe a gram. You do get some of those interesting intercepts like we've seen with Barrick at their 4 Mile project, right? But discovery, but those are rare. Those elephants at depth are rare, and they cost hundreds of millions of dollars to find. Yeah. So, I think there's been research to show that you're looking at a few $100 million in order to be able to make a discovery. So you're right. Exploration is going to be costlier, and it's also jurisdictional risk. Mm-hmm. We've seen some things occur in Africa where individuals have assets and governments change their mining regulations.